right, so let's talk about a market trend that I see happening and that is likely to accelerate. Banks are starting to get a little tighter in their lending practices. Carl's going to show you a chart that kind of shows how 40% of the banks have tightened their lending standards over the last quarter, I think is how this chart breaks down. At any rate, I know that there are some banks that are saying no more often. They're getting a little more picky with how they are going to lend out their money. So that's going to affect you guys in the real estate world. If you're going to buy a house or you're going to buy a commercial building, it's going to be less likely that you get approved. They're going to tighten up those standards a little bit. One of the reasons that's happening is the M2 money supply is contracting. So M2 is basically the money that is in the system, that is in the economy. There's less of that now than there was last quarter, and so it's measured quarterly, I think. And so, at any rate, I think in the last 60 years this has not happened, or at least maybe it hasn't happened to this degree or whatever, but just know that the M2 money supply is tightening. So on top of that, we have another 25% rate hike that's likely going to come next week to the federal funds rate. Now that doesn't specifically correlate to the mortgage rates, but it does affect it a little bit. Just know that if you're buying a commercial apartment complex or if you're buying a commercial industrial building, that extra 25% rate hike is going to affect your ability to cash flow that project. So there's going to be less chance that you get approved for that. So the lending standard has tightened a little bit. You're not able to get the money as cheap as you were last week. So there's that. The Federal Reserve is continuing the quantitative tightening program that they put in place a few months ago. Can't remember exactly when it was, but when the pandemic was announced, there were policies put in place that were quantitative easing. So the Federal Reserve basically bought some treasury bills or treasury bonds, however you want to say it. They bought these instruments, these financial instruments, where the United States Treasury sells a T-bill, a 2-year T-bill to the Federal Reserve. Federal Reserve gives them cash. It goes into the system. Now, it's not physical cash, digital, but you get the idea. So there's more money going into the system when it's QE. QT, quantitative tightening, is when money is coming out of the system. So the Federal Reserve, that T-bill, that 2-year T-bill is now over. So basically the Fed gave the U.S. Treasury money 2 years ago. That T-bill has now come to maturity, so Treasury gives it back to the Fed, and now they're not buying another one. That's how they tighten up the economy. So that's happening. And then the last thing is the debt ceiling. We're about to hear a lot of conversation around raising the debt ceiling again. So until that happens, the Treasury, the United States Treasury, has to basically spend money from their account, their operating account. They can't borrow from the credit card, so to speak. So they have to spend actual money in their Treasury account or their operating account, however you want to look at it. So that general account is being used and money is being drawn down from that account. Now, the law requires that money be replenished once the debt ceiling is raised. So imagine that you've got $10,000 in your bank account. You've got to go pay a bunch of bills, and you don't have any credit to pay those bills with, so you need to pay it with your operating account. Most of us can make sense of that. We don't want to borrow money to pay our bills. The United States government's a little different. Nonetheless, when the debt ceiling gets raised here in the next couple of months, you're going to hear things about the Treasury General Account, the TGA, having to be replenished. So that is also taking money out of the system and putting it back at the Treasury. So just know that all of these things are working to make it a little more difficult for you to get approved to buy a house, to buy a building, to buy land, whatever it may be. So the lending standards are tightening. If you extrapolate that out a little further, maybe the beginning of 2024, it's likely that prices are either going to stay stable or increase at a lower amount than they did prior, because there's just less money to be loaned on those assets, homes, buildings, all of those things. So I told you guys in the beginning of this year that I did not think prices would go down. I still don't think they're going to go down. I just don't think they're going to rise as fast as they have because of these things we just talked about. If you have any other questions, let me know. I'm happy to chat.